Thank you for taking the time to join us for our company's financial results briefing for the second quarter of fiscal year 2025. I am Sogo, CEO of AnyMind Group. I will now proceed with the presentation. This slide summarizes today's presentation. In the second quarter of fiscal year 2025, gross profit increased 15% year over year, or 20% excluding FX impact, maintaining a stable growth. On a gross profit basis, the marketing segment achieved 30% year-over-year increase, and the D2C e-commerce segment achieved a 51% year-over-year growth, primarily driven by growth in Southeast Asia. Also, due to the progress of internal operational efficiency through generative AI utilization, operating profit increased 49% quarter over quarter. Despite business environment changes in partner growth business, the marketing and D2C e-commerce segments targeting to enterprise clients continued high growth with first half cumulative gross profit growing 20% year over year. Revenue, gross profit, and operating profit are progressing above the previous year's progress rates against the company's full year forecast. In addition, our share buyback is progressing smoothly, with 76.3% acquired as of the end of July. AnyReach, which became a wholly owned subsidiary in March 2025, is promoting cross-selling initiatives, leveraging both companies' networks, with Q2 gross profit increasing 45% compared to pre-acquisition. The share acquisition of Vibula is in the final stage of regulatory approval process, with closing expected during the third quarter. Next, I will explain the performance highlights. In the second quarter of fiscal year 2025, revenue reached 13.2 billion yen, a 10% increase year over year, and gross profit reached 5.1 billion yen, a 15% increase year over year. Excluding the impact of foreign exchange, revenue grew 14% and gross profit grew 20%. Operating profit was 446 million yen, a 28% decrease year over year due to changes in the external environment that occurred in March, but we achieved a 49% increase in profit quarter over quarter. Our business that supports enterprise clients' growth, brand commerce, continues to show strong momentum. We delivered a combined 36% year-over-year growth from the two businesses that make up brand commerce, our marketing and D2C e-commerce businesses combined. Through operational efficiency initiatives, headcount increases have been controlled compared to Q1, and optimization of selling, general, and administrative expenses is also progressing. We aim to achieve continuous productivity improvements by promoting AI implementation and business process standardization globally. As you can see in the graph on the right, our total headcount remained almost flat compared to the previous quarter. This was because while we controlled headcount growth in our operations and corporate divisions through operational efficiency initiatives, we also continued to invest in future growth by hiring in our sales and business development and product divisions as planned. Additionally, gross profit per employee has been steadily improving. With the brand commerce segment continuing to grow, while we continue to firmly control SG&A, our operating profit has shown an improving trend compared to the previous quarter. The effects of internal AI implementation and global business process standardization are expected to make a substantial contribution to our business results from the fiscal year 2026. In the second quarter, we recorded a non-operating, unrealized foreign exchange loss of 231 million yen due to currency fluctuations. This resulted in a net income of 125 million yen. However, our adjusted net income, which excludes temporary factors like these exchange losses, was 372 million yen. I will now explain the summary of consolidated results for Q2. Revenue was 13.2 billion yen and gross profit was 5.1 billion yen, achieving year-over-year revenue growth despite changes in the external environment. As about half of our revenue is in foreign currencies, our results are significantly impacted by exchange rate fluctuations. To provide a clearer picture of our underlying growth, we have started disclosing FX neutral growth rates from this quarter. While operating profit and net income attributable to owners of the parent are at the levels we explained earlier, both have shown solid improvement quarter over quarter. We believe this demonstrates that, excluding foreign exchange effects, our underlying profitability continues to improve. Cumulative progress for the first half against the full-year forecast revised on May 14th stood at 47% for revenue and gross profit and 43% for operating profit, tracking ahead of the previous year's pace. Net income, while impacted by foreign exchange losses, is progressing in line with the plan. These are the assumptions for the full-year financial forecast that were announced in the previous quarter. As there have been no changes, we will skip the explanation for this slide at this time. This shows the quarterly performance trends. In fiscal year 2025 Q2, revenue increased 10% year-over-year and gross profit increased 15% year-over-year. Since approximately half of our revenue is denominated in overseas local currencies, the year-over-year growth rates are calculated lower in the financial report figures due to the impact of yen appreciation. Excluding foreign exchange impact, revenue increased 14% and gross profit increased 20%. Next, let me explain our performance by region. In the second quarter, our businesses in Japan and Korea are showing strong growth, leading the group and increasing their share of total revenue. On a gross profit basis, Japan and Korea accounted for 53%, Southeast Asia for 34%, and Greater China and India for 12%. Regarding the growth rates shown in the graph on the right, Japan maintained high growth of 30% year-over-year, even as we face changes in the global external environment. In Southeast Asia, although creative growth business was impacted by changes in the business environment, other businesses continued strong growth. Greater China and India recorded negative growth year-over-year due to the impact of the creator growth business, while marketing business maintained stable growth. The regional growth rates for brand commerce business, which excludes partner growth business affected by external changes, show growth across all regions: 37% in Japan and Korea, 41% in Southeast Asia, and 10% in India and Greater China. Operating profit for the second quarter was 446 million yen and was a decrease of 168 million yen year-over-year. However, quarter-on-quarter operating profit has improved. Additionally, adjusted EBITDA was 970 million yen, remaining flat year-over-year. This shows the breakdown of factors for operating profit changes compared to last quarter. Personnel expenses increased by 13 million yen quarter-over-quarter and remained stable, with the increase rate becoming non-linear to revenue growth due to productivity improvements brought by operational efficiency initiatives. The increase in depreciation expenses of 94 million yen is mainly depreciation costs associated with office expansion, which is an upfront investment for headcount increases in growth areas. IT expenses are partially linked to e-commerce sales, with 81 million yen increasing as variable costs. Overall, we are continuing to invest in growth while appropriately controlling personnel expenses, the main component of SG&A, to mitigate the impact on operating profit. This shows the quarterly trend for SG&A. Going forward, we remain committed to controlling the growth of SG&A by continuing to review our hiring plan and outsourcing costs. Regarding gross profit per employee, a key indicator we use for measuring profitability improvement, year-over-year growth slowed in Q2 2025. This growth slowdown was due to the impact from creator growth business, where profits decreased following changes in the business environment. On the other hand, excluding this business segment, the indicator has been steadily improving due to progress in operational efficiency. This shows the status of our balance sheet. In the first quarter, we raised additional interest-bearing debt, which was allocated to M&A funding and other purposes. Additionally, the total goodwill amount from 10 past M&A transactions is approximately 3.4 billion yen, and the ratio of goodwill to net assets is 0.21 times, maintaining a high level of safety. Although our cash on hand has decreased in yen terms due to M&A activities and the impact of yen appreciation and US dollar depreciation, we continue to maintain a sound financial foundation. The share buyback plan from April to September 2025 is progressing smoothly, and we have completed 76.3% of the program as of the end of July. Next, I will explain the progress of each business segment. In quarter 2, our enterprise-focused areas, marketing business and D2C e-commerce business, continued their steady growth. Partner growth business recorded negative gross profit growth year over year due to changes in the external environment. The gross profit margin for the entire group is 39%, excluding fluctuations due to business mix. There were no significant changes in overall gross profit margin. Synergies between the businesses have also strengthened, leading to gross profit share of 73% in Q2 from marketing business and D2C e-commerce business combined. This represents a steady expansion from 61% in the same period last year. Marketing business achieved high growth with gross profit increasing 30% year over year. Growth continues, driven primarily by influencer marketing, with steady performance seen in the Japanese and Southeast Asian markets. In Greater China, the business recovered to double-digit growth due to digital marketing demand recovery and increased Red Platform-related projects. Regarding the growth rate of gross profit by region in marketing business, Japan and Korea increased 35% and Southeast Asia increased 26%, showing steady quarter-over-quarter progress, while Greater China and India posted 13% growth. In marketing business, while most projects have historically been acquired locally by each country's sales team, we have recently strengthened collaboration between our countries and business units. As a result, we are seeing more projects that involve multiple solutions across several countries, boosting revenue through expanded cross-selling. On the right side of the slide, we have shown a few such examples. For Komehyo, a leading Japanese retailer and buyer of used goods, we began by providing marketing and e-commerce support in Singapore. Through subsequent cross-selling, our support has now expanded. In addition to providing the same offerings in Malaysia, our Japan team is supporting their e-commerce expansion into the United States. We are also continuously updating our products. The newly implemented AnyTag Insight enables AI to extract consumers' true opinions from social media, achieving standardization and efficiency in analysis work. Additionally, by adding MCP server capabilities to AnyTag, we are able to integrate agentic AI functionality to our influencer marketing platform and allows users to perform advanced platform operations simply by conversing in natural language without needing expert knowledge of LLMs or prompts. This capability enables workflow reconstruction and improves operational efficiency through AI. D2C e-commerce business grew by 51% year over year. Enterprise e-commerce support continued to perform well, increasing by 60% year over year. Growth in Southeast Asia was particularly remarkable, with Thailand's growth leading this business, and Aceh in Philippines, Vietnam, and Malaysia also achieving significant growth. Creator D2C achieved 42% growth in Q2 by allocating resources to high profitability brands. The number of creator brands increased slightly, and product portfolio expansion of our fitness D2C brand Lift and affiliated creator D2C brands Harajuku Mind and Shinako contributed to increased revenue per brand compared to the same period of the previous year. For enterprise e-commerce, we focused on acquiring new clients mainly in Southeast Asia, resulting in an increased total number of brands handled. Additionally, revenue per brand also increased year over year due to increased large-scale projects across all regions and regional projects spanning multiple countries. In the growing live commerce space, we are building a competitive advantage with our BPaaS model. On the product front, our generative AI live commerce platform, AnyLive, is evolving into a platform for maximizing overall live commerce performance. It can now execute various capabilities in real time, such as automated data collection and analysis of human and AI-led live streams, and use this analysis to optimize live host scripts to deliver better performance. The platform now supports 8 languages, including Japanese, which we added in June. We are also continuously adding more live commerce features to AnyTag, AnyX, and AnyLogi, especially around enhancing abilities to support TikTok Shop in Japan. Operationally, our unique cross-border support system, end-to-end support capabilities, and proven know-how from our successes in Southeast Asia continue to solidify our leadership position in the Asian live commerce market. With the launch of TikTok Shop in Japan, we simultaneously acquired all 3 types of certifications, making Japan the 6th country in Asia where we hold this recognition. Additionally, we have been supporting Unicharm on TikTok Shop in Southeast Asia since 2024, and we will support them in Japan as well for comprehensive support, including shop setup, marketing, and strategy development. Multiple other projects are also in progress. Anticipating the expansion of the social commerce market in Japan, we will deploy social commerce support by leveraging the track record, know-how, and technology cultivated in Southeast Asia. Gross profit for partner growth business decreased by 22% year-over-year. Creator growth business saw a year-over-year decrease in gross profit due to changes in the business environment, while publisher growth business remained stable. On a regional basis, while Southeast Asia, Greater China, and India experienced negative growth from these environmental changes, our business in Japan has already returned to a growth trajectory. This is a result of our successful efforts to diversify the revenue stream of creator growth business in Japan. The number of contracted publishers remains stable across all regions with no significant changes. Although ad unit prices remain sluggish across the industry, we strengthened our sales organization primarily in Japan, increasing the compositional share of high-margin apps. Consequently, gross profit per publisher has remained stable. Due to changes in the business environment, the number of supported creators is in a declining trend, but the decline has narrowed quarter over quarter. Revenue and gross profit per creator decreased compared to Q2 2024, which was during the rapid growth period for short-form videos, but remains at high levels compared to Q2 2023. In creator growth business, we are developing new models to avoid dependence on specific revenue models in light of changes in the business environment. We have developed a new revenue model by connecting game development know-how in publisher growth business with the company-owned IP in creator growth business. Harajuku Festival Dream Beat is a game app we developed in-house, which is linked to the music tour of a popular creator we support. The app has achieved a top ranking on the iOS charts, successfully maximizing user engagement time with the IP and generating revenue through in-app advertising. In creator growth business, following TikTok Shop's expansion into Japan, we have launched a production label specialized in beauty and lifestyle creators. Additionally, the live tour linked to the previously mentioned app was successful with many performances selling out. Our involvement includes support not only for the event itself, but also for related activities like merchandise expansion. This concludes our presentation. Thank you for your attention.